Welcome to today's Explainer. We're tackling one of the most fascinating corporate mysteries of the entire quarter today. We're looking at Siemens India's Q3 results for FY 2026. And honestly, it's a bit of a head scratcher. On one hand, you've got a company posting absolute record-breaking numbers. I mean, the order books are practically bursting, the growth momentum is undeniably strong, and they're just smashing their revenue targets. But on the other hand, the bottom line is telling us a completely different story. It's this massive puzzle where record revenue is clashing with a really confusing profit decline. So today, we're going to unpack this mystery step by step. We're going to figure out exactly what's working, what is definitely not working, and what all of this actually means for the future. So this brings us to the central question we really have to answer. How exactly can a company report double-digit revenue growth, specifically a 14% year-on-year jump to 3,831 crore rupees, and yet, at the exact same time, see a massive plunge in its profits? It sounds totally counterintuitive, right? Usually, when the top line grows that aggressively, you naturally expect the bottom line to follow suit, or, at least stay stable. But in this case, the mechanics of profitability completely broke away from the sales engine. Okay, let's actually dive into this, and let's start with the good news, because the scale of their sales engine is truly staggering. Just take a look at this number, 43,004 crore rupees. That is their current record-breaking order backlog. To put that into perspective, this gives Siemens India nearly 11 quarters of rock-solid revenue visibility. In the business world, having almost 3 years of future revenue essentially locked in, just waiting to be executed, that is an absolute dream scenario. They aren't struggling to find customers at all. The demand for their products is absolutely booming. But then, bam, we hit the friction point. Despite those record orders and that 14% revenue growth, net profit plunged by 26%, down to just 269 crore rupees. It's a glaring contrast. You've got these sales teams out there bringing in massive contracts, yet by the time that money filters all the way down through the income statement, a quarter of the profit has simply vanished compared to the same time last year. And this disconnect gets even more puzzling when we look at their book-to-bill ratio. It currently sits at 1.26. Now, if you track these things, you know that anything above 1.0 basically means a company is receiving more orders than it can immediately fulfill. It's the hallmark of a highly healthy, growing business. So you pair that with a very impressive 19% jump in new orders, hitting 4,829 crore rupees for the quarter, and this 1.26 ratio proves that market demand is incredibly strong. So, if the demand is there and the revenue is flowing, where exactly is the money leaking out? Section 1. The Margin Mystery. Solving the Puzzle. All right, here is our first major clue. When you look at the reported Q3 profit, obviously it's down that painful 26%, but hidden within those accounting numbers is a massive one-time provision of 74 crore rupees to comply with India's new labor codes. And this is absolutely vital context. This isn't some ongoing operational failure. It's a regulatory adjustment. If you just remove that 74 crore rupee hit and look at the adjusted profit, their bottom line is actually flat. So right away, we know a big chunk of that 26% drop is purely a one-off regulatory expense. But flat profit on a 14% revenue increase? Yeah, that still means margins are shrinking. Now, what's really interesting here is how we can isolate the true economic culprits that are eating away at the rest of those profits. Overall, total expenses for Siemens grew by 15%, which crucially is faster than their revenue growth. That is the literal definition of a margin squeeze, and it's pulling their overall margins down from 11.5% to around 11%. This squeeze is being driven by 3 distinct factors. You've got rising material costs impacting production, euro appreciation making imported components way more expensive, and broader forex or foreign exchange losses. These macroeconomic headwinds are basically the invisible forces dragging down their profitability right now. Section 2, Segment Breakdown, a deep dive by unit. So it's kind of like a giant tug of war happening inside the company right now. Smart infrastructure, which handles things like buildings, grids, and energy, is doing great. It's being driven by steady demand for data centers and urbanization projects, and most importantly, its margins actually held up well. Meanwhile, mobility, which deals with trains and transport, posted a massive 28% growth. But those forex headwinds we just talked about, they took a serious bite out of its profitability. The orders are definitely there, but currency fluctuations just ate the profits. Finally, there's Digital Industries, focusing on factory automation and software. It's recovering and getting back to normal operations after a tough year, but it is heavily dragged down by cost inflation from the euro. Basically, every single segment has its own unique battle to fight. Section 3, Macro Context. trade and growth. So, management is looking at all this, and they're maintaining a cautiously optimistic stance. You can clearly see the tailwinds they are banking on. The recently signed India-EU free trade agreement is a massive opportunity. It opens up brand new export channels for Siemens' locally manufactured products. On top of that, the broader U.S. trade deal is expected to boost Indian manufacturing as a whole, which indirectly funnels right back to Siemens. But there is a pretty significant headwind they are watching really closely: the slow recovery in domestic corporate investments. Private capital expenditure just hasn't fully bounced back yet. Which brings us to a crucial point. Until private companies start opening their wallets again and spending on major factory upgrades and automation, government infrastructure spending has to carry the heavy lifting. The public sector orders are pretty much the engine keeping that 43,000 crore rupee backlog growing right now. Siemens is heavily reliant on the government continuing its push to build and modernize the country's infrastructure just to bridge the gap until the private sector finally wakes up. Section 4. The investor verdict, the bull versus bear case. Let's neatly juxtapose the two competing realities facing the company today. On one hand, the bull case is built on undeniable top-line strength. I mean, you have a record-shattering backlog, a relentless government infrastructure push, and a clear operational recovery in their digital industry segment. If they can just manage to stabilize their margins, their earnings are going to violently catch up to their revenue growth. However, on the flip side, the bear case is grounded in the very stubborn realities of the present. That margin pressure, it isn't magically disappearing tomorrow. Material costs are still high, forex remains incredibly volatile, and that one-time 74 crore rupee labor provision, well, it kind of hints that there could be more regulatory compliance costs hiding around the corner. Ultimately, I think it all boils down to this perfectly accurate quote. Siemens India right now is a growth with margin drag story. The top line, the sales, the demand, the market share, is firing on absolutely all cylinders. They are winning the business, no question. But the bottom line, the actual profitability mechanics, needs immediate, focused work to navigate currency fluctuations, inflation, and these regulatory shifts. Which leaves us with the ultimate question as we wrap up today's explainer. You've seen the record-breaking order books, and you've seen the very real economic headwinds eating into their profits. So, weighing that massive multi-year revenue visibility against the ongoing margin squeeze, is Siemens a buy at these current levels, or do you really need to see those margins stabilize before you buy into the hype? Take these insights, dive a little deeper into the numbers, and decide for yourself how you think this puzzle ultimately gets solved. Thanks so much for joining me on this explainer, and keep learning.